April 8, 2026. JPMorgan Chase, the most powerful and profitable bank in American history, quietly made a move that most people are underestimating. Jamie Dimon is stepping back, not disappearing, not retiring, but handing over day-to-day control to his chosen successor, Marianne Lake, starting January 1, 2027. While he remains behind the curtain as executive chairman, shaping strategy, but no longer pulling the daily levers, Wall Street didn't panic, they exhaled. Because this wasn't chaos, it was precision. A clean succession, a controlled transition, continuity locked in. But here's what most people missed. This isn't just a leadership change. It's the closing chapter of an era that began in 2005. An era that survived the financial crisis. Sovereign debt shocks, credit downgrades, a global pandemic, and the most complex financial buildup in modern U.S. history. And just 6 days later, the same bank reports $16.5 billion in profit, $50.5 billion in revenue, blowing past expectations. On the surface, everything looks strong. But when a system performs this well, at the exact moment its most battle-tested operator steps back, you don't ignore it. You pay attention. 23% return on equity, nearly double the European banking average. Record-breaking numbers by every definition. JPMorgan Chase just closed 2025 with $57 billion in net income on $185.66 billion in revenue, the most profitable year in its 200-plus-year history. But if you think that's the story, you're looking in the wrong place. Because if you actually read what Jamie Dimon said in the earnings call, in his April 6 shareholder letter, and if you track what their $4 trillion asset management machine has quietly been doing with institutional capital over the last 18 months, you realize something unsettling. The profits aren't the signal. The exit is. This is about where the money is going next. And by the time this video ends, you'll understand exactly why. The man who navigated the world's most powerful financial institution through every major crisis of the last 2 decades is choosing this exact moment, under these exact macro conditions, to hand over control. A moment defined by Iran tensions, a $39 trillion U.S. debt load, rising stagflation risk, and cracks forming in private credit. You'll see why hundreds of billions are quietly rotating out of paper assets and into infrastructure, real estate, commodities, gold, even timberland. You'll understand the exact language Wall Street reads as a macro warning, but retail investors still haven't acted on. And most importantly, you'll walk away with 3 precise moves the data is pointing to right now, based on what the most data-rich institution in the global financial system is telling you it believes comes next. Start with the exit, because this isn't about succession, it's about timing. Jamie Dimon had every reason to leave over the past 5 years. Political offers, treasury speculation, public frustration with regulation. He could have handed over power in 2023 or 2024, when markets were strong, profits rising. And the narrative would have been simple. A victory lap at the top. He didn't. He chose April 8, 2026, 5 weeks after the Iran conflict began. With oil above $110, with the Strait of Hormuz operating under strain. With U.S. debt at $39 trillion, growing by nearly $2 trillion a year, with recession odds near 50%. With private credit deteriorating faster than conditions should allow, and a Federal Reserve trapped between inflation and a weakening labor market. This wasn't random. This was the message. In his April 6 letter, Dimon described a system under pressure, like tectonic plates shifting beneath the surface, building toward disruption. Geopolitics, unsustainable debt, trade fragmentation, a $1.88 trillion private credit market now larger than U.S. high-yield bonds. Asset prices stretched across nearly everything. He didn't step down at the peak. He stepped aside at the pressure point, now layer in the real risk. Not just geopolitics, not just debt, but a system being disrupted from the inside out. Jamie Dimon warned that AI is both an opportunity requiring massive capital and a direct threat to traditional banking, with new competitors emerging from blockchain ecosystems. And then he said something most CEOs avoid saying out loud: stagflation. Not possible someday. Possible this year. Driven by energy shocks pushing inflation higher, while the Federal Reserve can't cut rates without making it worse. A scenario where inflation wins and growth loses. He put that warning at the very top of his April 6 letter, and 6 days later he stepped back. That's not coincidence. That's signal. But what he said publicly is only half the story. The other half is what JPMorgan Chase is doing with $4 trillion of institutional capital. Their 2026 outlook points to where money is actually going. Infrastructure at 6.5%, gold upgraded to 5.5%, timberland at 6.3%, U.S. real estate at 8.2%, commodities at 4.6%. This isn't theory. When institutions adjust, capital doesn't move in millions, it moves in hundreds of billions. And Q1 2026 confirmed it. Trading revenue surged, led by commodities. That's not noise. That's the footprint of capital rotation into real assets at scale. Let's quantify it. JPMorgan Chase manages $4 trillion. Allocate just 12% to real assets, infrastructure, commodities, gold, real estate, timberland, and you're already at roughly $480 billion. Call it what it is. $500 billion. And that's a conservative estimate of institutional capital being positioned into physical assets right now. Not theory, not speculation, action. Because when Jamie Dimon talks about stagflation risk, geopolitical fractures, and unstable debt, and at the same time the bank's own data shows a surge in commodity trading, driving a 21% jump in fixed income revenue to $7.08 billion in Q1 2026. That's alignment. That's positioning. In his April 14 statement, Dimon didn't soften it. Rising complexity, war, energy volatility, trade uncertainty, massive deficits, elevated asset prices. And then the key phrase, preparing the company for a wide range of environments. Translated. Build portfolios that survive when things go wrong. Infrastructure for inflation. Commodities for price shocks. Gold for currency instability. Real estate for supply constraints. Timberland for long-term inflation hedging. These aren't assets for a perfect outcome. They're assets for disruption. And before stepping back, Dimon made one final move. Tilt the system toward the real world. Let's go back to history, because this pattern isn't new. In 1996, Alan Greenspan asked one question. Irrational exuberance? Markets dipped, then surged for 3 more years. Retail investors who exited early underperformed. But in 2000, the NASDAQ composite collapsed 78%. Greenspan was early, but he was right. That's the lesson. Timing can be wrong, but the risk is real when insiders start speaking. Now fast forward. In 2007, Jamie Dimon didn't warn loudly, he acted quietly. While others piled into mortgage risk, he reduced exposure and built liquidity. Then came 2008. Lehman Brothers collapsed. JPMorgan Chase didn't just survive, it expanded, acquiring distressed assets and gaining dominance. That wasn't luck, that was positioning before the break. Now look at 2026. This time, Dimon isn't subtle. He's openly warning stagflation, unsustainable debt, private credit losses, global fragmentation, and at the same moment, he steps back. In 2007, the signal was hidden. In 2026, it's public and paired with action. That combination? It carries weight no single warning ever could. Let's go back even further because the third pattern matters the most. In 1979, Paul Volcker stepped in to stop runaway inflation. What followed wasn't a smooth recovery. It was a decade of stagflation. Growth slowed, unemployment rose, inflation stayed high, and here's what broke: paper assets. Stocks went nowhere in real terms. Bonds were crushed by rising rates. But real assets? Gold surged from $35 to over $800. Infrastructure, energy, real estate, commodities, they preserved purchasing power when everything else failed. Now fast forward to 2026. Jamie Dimon isn't predicting a repeat of the 1970s, but he is warning about the same structure: stagflation risk driven by energy shocks, persistent inflation, and a Fed that can't cut without making things worse. And the data is already confirming it. Inflation rising. Oil shocks feeding through. Recession risk near 50%. This isn't hypothetical, it's unfolding in real time. And institutions see it. They've read the warnings, they've seen the numbers. And they're moving into infrastructure, commodities, gold, real assets. That 21% surge in commodity revenue at JPMorgan Chase, that's not a statistic. That's the footprint of capital repositioning for what comes next. This isn't stability, this is pressure building. On the same day JPMorgan Chase reported, Larry Fink revealed $9 billion flowing into private markets led by infrastructure and private credit. But look closer. Strong demand for infrastructure and warnings on private credit from Jamie Dimon point to the same shift, away from fragile paper credit toward real, tangible assets. That's the signal. Two of the largest asset allocators on Earth speaking the same language on the same day. The era of easy credit is ending. The era of real asset premiums is beginning. And then there's the timing. Dimon didn't step down in strength. He stepped back after issuing his most urgent macro warning in 20 years, while positioning the bank toward real assets and handing off a fortress balance sheet built to survive volatility. That's not symbolic, that's strategic. A system prepared for disruption, not perfection, because the fortress wasn't built for calm markets. It was built for what comes next. And the real question is simple: is your portfolio built the same way?